Hey guys, Adam Rose, Vice President, Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. Today's another episode of the Mortgage Guy Podcast. We're going to focus specifically on refinancing since there's been a lot of talk over the last couple of weeks. Leading up to the Fed announcement on the rate cut, rates moved usually about 2 weeks beforehand, and they may last a little bit longer. But there's been a lot of talk about it. A lot of loan servicers are out there hammering the phones. To any of my current clientele out there looking to refinance, I do ask, hey, give us a shot. I'm only one person. I'm not a call center, so I can't call everybody constantly and keep them informed of what's going on. So, a lot of loan servicers are out there. They're going to be calling you every day, mailing every day. Sometimes our deals are better than theirs. Sometimes they're not. You know what I mean? So get a second opinion, but we appreciate your business. Hope you can support local so we can keep doing what we do and inform the masses and help people obtain home ownership with new purchases and refinancing. So anyways, let's talk about rate term. What is it? We say rate term, and some people might get confused on it. Rate term is specifically just to reduce your interest rate, okay? It can save you thousands over the life of the loan. Just a quick example, though. If you have a $200,000 loan amount, you go down 1 point in your interest rate, it should be approximately $100 to $120 a month in savings, give or take slightly, per month, just on the principal and interest portion of your payment. You can always look at reshopping the insurance. You can always reshape all that. If you're willing to bring some money to closing, we can keep the loan amount down. But that's the design. That's the whole purpose of it, is simply just to save some money on your payment. Now, usually what we do, and we're going to talk about the other options available, of course, is we try to finance some of your expenses in. Our closing cost expense are dramatically reduced for refinances for in-house clients or past clients of ours. But you still have some title work that has to be done. And the big thing is refilling the escrow account. Okay, so it makes the closing cost worse than what it truly is. Because when we refill the escrow account, we're putting your taxes back in there. We're getting your insurance extended out for at least 12 months from your closing date. And there's some stuff we got to collect. But you got to remember, the escrow account balance that you have with your current loan servicer, once that loan's paid off, they're going to refund it back to you. Now, there's a handful of lenders or loan servicers out there that are going to discount your payoff. So we just got to, so it's as broad as it's long, right? But nonetheless, something to consider. And there's a lot of things you can look at. And the benefits of refinancing, not just lowering the monthly payment, even though there's costs involved, is you could possibly skip a payment. Sometimes you can skip 2 payments depending on when you close. So there's a lot of goods to it. So we just got to figure out what's the right point for you to pull that trigger. What makes the most sense? So contact us. I'd be happy to help you out, run payment scenarios for you, and you can target a rate of, all right, here's where we got to be in order for this to make sense for us. Or it might make sense for you right now. If you're over 7, 100% makes sense for you right now. Government lending rates especially are fantastic. They start with a 5 on the government lending rates. Okay. Again, I don't like to quote rates and then APR and all this fun stuff. But they're in pretty good shape. Conventional's a little bit higher always. But you can get it down with the buy down too. So you can also do on a rate term. You can look at possibly going from a 30-year to a 20 or 15-year. Now, does it save you a ton on the rate? Not a lot. It's going to be a little bit better. The 20-year and the 30-year is almost identical. But what it's doing, and it's going to increase your payment a little bit. You're not going to save any money monthly, right? That's not the point of decreasing your term. But what's going to happen is it's going to reallocate where your principal and interest payment is going. More of it is going to be going towards the principal balance versus interest compared to a 30-year. So even if your payment went up by $200 or $300 or whatever it might be, you are paying the balance down significantly faster with that shorter term. So that might be up your alley as well as rates move downward. And it's a lower risk refi anyways because you're not taking any cash out. So let's talk about other types of refinances. Let's talk about Streamline. So there's actually 3 options on Streamlines. You've got a VA IRRRL, interest rate reduction loan, which is a Streamline. And when we say Streamline, there's no appraisal needed. All right, so that's kind of our reference point. But with VA, you can still finance closing costs in even without doing anything with an appraisal. You have an FHA Streamline, and you got a USDA Streamline. USDA allows you to finance some closing costs in as well, no appraisal requirement. FHA is the only oddball one in my opinion, when you're trying to calculate your loan amount. So with an FHA Streamline, the rate may not be as low as doing a rate term refinance, but why that is, we try to because our loan amount can't go any higher than the original loan amount, basically, in a nutshell. Okay, so there's not much room, anyways. You can't finance anything in hardly unless you paid down the balance pretty good. But so you can't exceed the original loan balance, and so you're going to usually bring some money to closing. So usually we try to design it in such a way where your rate might be an eighth or a quarter point higher than what a rate term would be. Again, contact your lender. Every scenario is going to be different, and we try to lender credit that back to you to cover that expense on closing in hopes that you may bring a mortgage payment to the closing table. So like if you closed in, on October 25th or something like that, you would basically just, instead of making your November payment, you're just going to bring it to the closing table. Your first new payment on your mortgage would start in December. So something to remember. So, and on that, I mentioned it earlier, I just didn't go into it. If we close in October, your first payment is December, you typically will skip November payment in that case. But again, depending on when you close, what time of the month, and all that, it's very possible you could skip 2 mortgage payments, but it's kind of built into your payoff a little bit because you kind of get hit with interest and stuff. USDA is a fantastic one. It's my favorite one. All my USDA clients are going to be getting some phone calls from me over the next week or so to see if it makes sense. It's just a great program. No appraisal requirement. We can finance some stuff in, cover your insurance, your taxes, and all that fun stuff all over again. And some of these streamlines, you can do them every 6 months. I'm not a fan of that personally. I honestly miss the boat a lot of times on doing refinances for people because when I look at their file, I don't feel like it's the right time for them. But a lot of people are doing it with the loan servicer because they're getting calls and just pounded every single day. So they eventually convince themselves it makes sense. We're seeing servicers only saving you a half a point, dropping your payment $50 to $60 a month, maybe. And then they're trying to do it all over again 6 to 12 months later when the rates continually drop. I just don't like that. I don't think that's fair to the client. You're still incurring costs, time, effort. It just doesn't make any sense. So, some people do it, but just not me. It's just not me. So maybe that's my own fault, So I don't want to bother you when it doesn't really make sense for you to do it. But maybe I need to pick up my game there. And then the other one that's happening, it's been happening even with rates higher before this little rate drop that we had, was cash out refinances. So what this is you're going to be tapping the equity in your house, right? In most programs, FHA and conventional specifically, you're going to go 80% loan to value. 80% loan to value. So if your house is worth $100,000, $80,000 is your top loan amount, right? What we're doing and what we're seeing a lot of is reallocating some of that money, taking the little bit better rate, especially if you're in sevens, dropping your interest rate, but tapping into that equity, paying off high interest credit card debt. People are paying off auto loans. I'm not a big fan of auto loan payoff, however, because usually the auto loan rates aren't too bad, right? If you have some of these Santanders and Exeters and stuff like that, they might be charging you, 15 to 20% on some of this. Let's get rid of that for sure. But typically speaking, if you're going through the dealership or if you're going through directly through Honda or GM Financial or whoever it might be, they're typically offering you a much better rate. But it can still make sense to get rid of them depending on your disposable income situation, So it's something we always want to look at. Autos, credit cards, I typically don't advise going after student loans. You never know what's going to happen with those student loans. So it's something to entertain. It can really free up a lot of cash. We've had people doing cash out refinancing, and they're saving $1,000 to $1,200 a month on their disposable income because even though their mortgage payment might have been a little bit higher, right, than what it was before, getting rid of all that consumer debt has just freed up and changed their lifestyle completely. If you can think that you could free up $1,000 a month in consumer debt, and you decided, hey, well, I feel a lot better, I'm going to apply an extra $500 a month of that consumer debt towards my mortgage. Good God, just think about what you can do and how much interest you can save over the life of the loan on your mortgage as well. So there's a lot of great tools out there that you really got to look at, whether it's a HELOC, a home equity line of credit, or doing a cash out refinance. One of those typically is making sense because everybody knows in this day of age with inflation and the cost of goods, everything's just more expensive, right? Our wages have not outpaced inflation or the cost of goods and the cost of living. So sometimes using and tapping into the equity of your home, it makes sense. And especially with some of these cash out refinances, when you have FHA and USDA specifically, if you recall, a couple of weeks ago we had a podcast that you will now get a tax exemption or tax deduction for your PMI, right? So that's another added benefit. Could make sense. And then I wanted to touch on VA cash out real fast. So VA, because we always talk about 80% loan to value, right? I gave that example. VA is a little bit more aggressive. I highly, highly suggest hitting 90% loan to value. There are some options for 100%, but I'm going to tell you, you're going to pay for it in the rate. It hits you pretty good. So they're a little bit more lenient. You have a lot of options to go a little bit higher. Don't suggest going that route because the rate and costs are not nearly as attractive as if you can hit the 90%. So they'll let you tap a little bit more equity than conventional or FHA will. So just a quick podcast for that, guys. If you're in the market, give us a call. I'd love to help you out. But a quick recap again: rate term, mainly saving interest, right? Saving your money on your monthly payments because of a drop of interest. Streamline is a little bit quicker, a little bit easier, not as many validations that we have to do and verifications for employment and income. But you might be bringing a little bit of money to the closing table, can't finance closing costs in, typically, depends on program. And then cash out, again, tapping equity. We're going to pull out some equity, and then you can pay off a lot of consumer debt or do with it whatever you want. Some people have used it for additions. I have a guy that's coming in that had a HELOC that's about to expire, so he can't borrow against it anymore. So now it's a fixed monthly payment, but the payment's doubling. And so we're actually going to do a cash out refinance because he also wants to buy a vehicle. And with the amount of cash he's going to get and refinancing the balance on the HELOC, the monthly payment is still less than what the fixed payment was going to be on the HELOC after it converts because it's doubling. So that's pretty cool too. So I mean, there's a lot of cool options. You just got to take a look at it and see what makes sense. Again, not big sales guy, so I'm not saying you have to do it, right? It's just it may be good for you, it may not be. All right, you're not going to know until you inquire. So that's all I got for you guys this week. I hope that information is helpful. If you do have questions, all of our information is at the bottom of the screen along this banner. Holler at us. Remember, subscribe on YouTube. Check us out on Apple Podcasts and Spotify. And you're going to see us on TikTok and all of our Facebook reels as well. But we'll catch you all next week.